Hey traders, Ryan from blockstocks.com. This video is a video about taking a trade from our insider finance real-time option flow and evaluating the trade, making sure it makes sense, and then determining what trade to take. So what you see here is just the insider finance dashboard, and what I was doing, I was just kind of scrolling across these, and we're going to focus on the momentum trade today. And looking like the momentum sort here, we've got Shapeways, COM, PBT, Sono. And so down here is the real-time option flow just coming in, by the time. And then up here is the platform's sorting feature, where you can sort by different things here to kind of see where they lie. So for example, down here in real-time option flow, one of my favorite things to do is to sort by heat score, which is algorithm that takes the human emotion out of the trade here. So I'm going to sort this by heat score. And you can see that some of the top highest conviction trades are occurring in this SHPW. And what that is Shapeways. It's a 3D printing for industrial use. And then what I like to do in here is I like to sort by either unusual number of contracts, so we can click that and see what it comes up with. We've got Wish, Nokia, and then Shapeways down here. And then another thing I like to check is unusual out of the money. That means that institutional money thinks that certain tickers will go up by that amount. So for example, in Wish, for example, if you check their ticker, if they're saying, let's say that, let's just click it for an example. If they're out of the money, it's currently trading at $6, but most of their trades are in the $7 range. That means that institutional money thinks that Wish is going to go to $7 at least. But I'm not going to trade that one. I'm going to go back here to our dashboard. So we're going to focus on unusual volume and unusual out of the money. Okay, and so we're going to sort this here by unusual out of the money, and we're going to sort this one by heat score. And so to me, we're getting a top hit here on our Shapeways, which is the one I want to focus on today. Going to change this to momentum, and we can see that out of all the tickers, based on the momentum of where the chart is going, that Shapeways is in fact have the highest momentum. So what I'd like to do is do a little bit of ticker research. You can either click this beacon, or you can click the actual the name here on any of these, and it'll come up with the ticker research. So I'm going to click on that, and it's going to show us where all the orders are going in. So keep in mind, these are orders from institutions, not retail traders. Some of these could be retail batches. So for example, Ameritrade might put in a batch order for something like this. So then what I like to do here is I like to sort by the heat score to see the highest conviction. We can see that there are some puts, but they're mostly calls, and so we're going to check that on the options chain in just a moment. Now you can see here, as we sorted by heat score or highest conviction, that we're getting basically all November 19th, and they're all November 19th. And the strike price, or where institutional money think price could go, is from $8 to $10, and maybe even $12.5. There are also a number of orders for the $7.50. So we've got to keep that in mind, because that might be another way we could trade it. So let's now go to my Thinkorswim, and we're going to look at first the options chain, then we're going to look at the chart, and then we'll go back to the options chain to evaluate what trade to take and why. So here is my Thinkorswim. Let me just close this so you can see. And I really like this chart. We've got the squeeze pro, or basically this is a momentum indicator, saying that for a while we were having either sideways or downward momentum, but we've reached kind of this base of support right here to the point where we've basically run out of people that want to sell at this level, and now we're either getting people who are buying to close those short positions and or picking up dip buyers at this level here. And we have further confirmation that on this compound breakout and MACD that the momentum is shifting to the upside. Now let's think about those price targets. One of them was 7.5, and you can see here that the price has already gone from $7.15 to in the $8 range. So we've already exceeded the 7.5 price target, although you could still trade that option, and I'm going to go over that in just a moment. But let's look at the next price target, which was $10, which is somewhere in this range here. That's quite a jump there. And then the next range after that was 12.5, which is way up here. So I think it's reasonable to trade anything below $10. Shooting here to the 12.5, you could do that, but there's some risk that if price doesn't go that high, that you could end up with a loss. So down here in the news area, we've got Shapeways saying that they've released some kind of technology that's going to help make 3D printing more efficient. Let's now look at the options chain. And let me close this here a little bit more. What I like to look at first is the put-call ratio. And so this is measuring how many puts there are in total versus how many calls. And there's very low number of puts. So if the put call is less than 1, that means there's not as many puts. But if there's more puts than calls, then this number would be above 1. But we can see here already that the total volume of options is only 561 puts versus 14,000 calls. So I wouldn't say this is 100% bullish, but it certainly is mostly bullish. So now that we know that most likely the price is going to go up, not down, and we've also confirmed that in our chart that we have basically seller exhaustion. So I like to use this ready aim fire, saying that hey, we don't have too many more people that are going to sell because we've run out of people that will want to sell. So at this point, people are either buying to cover short positions or dip buying to go to the upside. So going back to the options chain, I've already placed an order, but let me show you the different ways we could trade this. So the first thing I like to do here in the actual options chain is determine our trading range. And the way I like to do that is to take the market value, and that's interesting, just in the time that we were talking, it went from 825 to 843. And you're going to add the market price, which is 8.43, 8.43 plus this expiration's volatility, which is 2.586 plus 2.586, and that's going to give us $11. So the upper range is $11 on or before November 19th. Now we also have to keep in mind there's something else here called a market maker move, and that's an additional amount of volatility plus or minus 2.142 on top of this. So we're going to go ahead and add this 2.142. That means that the market makers who are pricing these options believe that it's possible but not guaranteed. It's possible that Shapeways could go as high as $13.16. So I think the safest way to trade this is down here in the delta 70 range here. Delta is the amount of how much the options are going to go up per dollar move. That's the safest way to go, because if the trade doesn't go where you need it to go, you'll still have value in the option because of intrinsic value. Now, the other way that most of the trades were occurring was in this at the money range of $10. And you could do it that way too. In fact, you have quite a lot of volume in this area here. So you could trade $10, and I would feel confident in taking $10. I think it's a bit more risky to take this $12.50 range, because there's no guarantee that the price is going to go from $8.50 to 12.5 in a month's time. It can, and that would be the best way to use leverage, because these options are super cheap at 35 cents. But again, there's some risk. The risk is higher here that you're going to end up with a loss, because there's no guarantee that it's going to trade up to 12.5. However, it's very likely that it's going to trade, it already has traded above 7.5, and now we're shooting for the $10 mark. And we just needed to hit 10, get close to or hit 10 or above by November 19th. So there's quite a lot of time to get to that point. So the way that I traded this was to take the delta 70 calls here. It's a little bit more expensive at $1.55 currently, but let's say, for example, that the price did not go to $10. If it did not go to $10 on or before November 19th, then these $10 strikes could lose money. However, if I keep my $7.50 strike, it's still in the money, then it will retain some value because it's got more intrinsic value than extrinsic value. So in my opinion, I like, whenever I get a trade alert from either Insider Finance or somewhere else, I'll look at the trade, but I'm going to take my own trade based on my my tolerance for risk and loss. So I'm going to take this trade. Another way you could do it is you could do a spread. You could do a debit spread. You could do maybe 7.5 to 10 debit spread. So you'd be buying the 7.5 and selling the 10 in one trade. And not only would that increase in value from the increase in price, but also the increase in volatility. The other way you could do it is you could, oh, that jumped up quite a bit. You could do it from 10 to 12.5. In fact, maybe I'll do that just as an example, because we're getting some volume here in the 12.5. So I'm going to switch this to vertical. And what I'll do is I'm going to buy the $10 and sell the 12.5 in one trade. So what you do is you hit buy. And you're going to capture any profit between $10 and between its current micro price of 8.5 to 12.5. And you're only spending $35 or $30. I'm actually going to do that. And in that way, you can actually increase the number of contracts you do. Here's the results of the trade. The in-the-money 7.5 single option profited 133% with just one contract. Then I set up a vertical debit spread to capture the profit between 10 and 12.5. That made $250.